we could be in the midst of the last big run-up before this market pulls back big time. Over the last week, you can see that the S&P has been up about just under 5%, 4.63%, and QQQ 6.41%. Now, when you often look at what happens when there are big pullbacks in the market, there's one last rally. And what does that entail? So this was 2007 leading into 2008. Now look at this. We could do no wrong. The market just kept going higher and higher and higher. And you can see that it had these just big break step patterns. And we kept thinking, we're going to go higher. We actually made all-time highs here right in the beginning of 2008. And that's when everybody kept thinking, this thing's just going to go. It's never going to stop. And what happened after that? You had a pretty big fall. Slight rebound, pretty big fall. Slight rebound, pretty big fall. And this is what we could be getting into right here. Let me slide over to what we're seeing today. Today, we're seeing that very similar thing, where you're having this big run that's going on. And what are we having? We're having that same kind of break step pattern. Let me zoom this in so you can see it. We're starting to see that rally, fall, can't break out above the high. Fall, rebound, can't break out above the high. And today, we're sitting right here where it can't break out above that high. This is the S&P. I'm going to pull up the NASDAQ, and I'm guessing it's going to fit right in my circle. Right there, same exact thing. It's having a hard time breaking that high. So what's the reason for these rebounds? Let's look at NVIDIA real quick. The interesting thing about companies like NVIDIA are, and for those of you that don't understand trading, I'm going to explain something very simple to you, just so you can understand, everybody can understand. This right here is a downtrend. All the volume is facing down, even though this thing has rebounded from $390 a share to $460 a share within a matter of 8 days, 6 days, whatever it is. You have still not changed the downtrend. What is that reason? It's a short covering rally. So what is that? If you're short a stock, what are you doing? Well, you're shorting it, you're borrowing it, and you're selling short. And to get out of this, what do you have to do to get back? Well, you have to buy a stock. So you are actually buying a share, and you're doing what's called buying to cover. Now, when you're buying to cover, it looks like there's buying volume coming in because it's actually a purchase of a stock. And if there's nobody still selling short, what's happening to the stock price? This is happening to the stock price. It just continues to go higher. So when you see these rallies where the market is just going up and you just continuously see these big days that are happening, but your overall trend of the market is not changing, what's happening? It's a short covering rally. There's not real buyers in there. And that's where these last minute rallies and last big pushes of the market occur, and that is where people can get faked out. So you're probably saying, well, Mo, that's NVIDIA, and I could pull up Tesla, I could pull up anything. Well, what I'm going to do is I'm going to pull up the S&P 500. And we can look right here at SPY and say, this thing has gone from maybe $410, $409 to $437 in a matter of 8 market days. That's basically 2 weeks. And you still don't have a big trend change. Now let's look at QQQ. This is the NASDAQ. This is the tech-heavy NASDAQ. This one's even worse. You have gone here from about $340, maybe $342, to $373. Look at that big run that you've gone on. Every single day has been green. Every single day the market has been going up. And your trend is still not pointing in this direction. That to me tells me that this is a short covering rally. There are not real buyers in the market. And when I see major indices doing this, not just the Magnificent Seven, it does worry me. So something else that's gotten me here, and this is something that you hear the pundits on television talk about. It's the yield curve. And when we think about the yield curve, what's going on? Yield curve, for those of you that maybe are new, you're looking at what you get from the government, basically. If you loan your government money for 10 years, they're going to give you a return. It's somewhere around 5%. I think it's a little bit under right now. If you loan it to them for 2 years, you're getting right now somewhere, I actually think it's around that 5% number, maybe 5.5%. When these two switch and you're getting more return to give to the government in a 2-year period than a 10-year period, that's a yield curve inversion. And with this, these two have been inverted. So this is actually sitting, this is around, call it 4.5% right now, and this is around 5%. So you can see that you're getting more at this rate than this rate, and that's a yield curve inversion. And these have been inverted since July 6th of 2022. And I think that almost every single time, somebody can fact check me here, but I think it's almost every single time that the yield curve inversion has happened, there is a recession that comes within 12 to 18 months after that. we're getting really close to that 18-month period. So we have 2 more months to go before it expires. Maybe it's different this time. Maybe that's the case. And maybe it doesn't happen every single time. There's a lot of things going on. One other thing that's going on right now that actually gives me the reason that we are not seeing a real recession right now, and that's the banks. The banks have so many unrealized gains. If you go and look back at their earnings, everything was fine. It wasn't that bad. But if you look at the unrealized losses, I said unrealized gains, unrealized losses, the banks are in some serious trouble, and banks lead the market. I do think that there's a banking problem. There's a liquidity problem. The Fed is having to bail out the repo market because the big hedge funds and institutions are not doing anything with the repo market. We are in a lot of trouble, and that's what kind of makes me say, all right, there's a lot going on here. Maybe the short covering rally is the last big thing. But does that mean that you should panic and raise hell? No. If you're the average person that's dollar cost averaging in ETFs, continue to do that. There's no reason to panic. We are going to be better off 10, 15, 20 years from now in the stock market. It has always been happening. Even we've gone through the Great Depression. We've gone through the great financial crisis. We've gone through 9/11. We've went through a global pandemic, and it always comes out better. It's going to just take some time to rebalance things. If you're the person that invests in individual stocks, what should you do? Just remain patient. When you find good opportunities, go and grab them. When you don't find good opportunities, just sit there and wait. There's no sense of panicking and going crazy and doing irrational things. So let's look at a couple of other metrics that kind of show me, hey, maybe we're out of whack right here. And that is the stock market indicators. Paul actually updates these every day in the community, and I'm pulling these right off of our community website right here. So 2 of them that he pulls up here. The Buffett indicator, which is the stock market to GDP ratio. And that right now is sitting at 68.5% overvalued. Now, let's talk about what it's done in the past. So if you look at 2021, 2022, I believe that this number was around 107% overvalued. So you can see that it is coming down. We are off of those crazy highs. And if you really look at the stock market over the last 2 years, we're flat. The S&P 500 is flat. And if you take out the Magnificent Seven, I don't know this for a fact, but I'm assuming that it's down because this year the stock market is basically flat. I think it's a little bit positive if you strip out the Magnificent Seven, those being the big ones: Google, Amazon, Apple, Tesla, Nvidia, and I'm forgetting 2 more. Then you come over here to the 10-year CAPE, or 10-year cyclically adjusted PE, also known as the CAPE-Shiller. So it's the price of the market divided by the last 10 years of earnings, and it's adjusted for inflation. And you see that we are about 73% overvalued. These numbers are both end of the day on the 3rd. He updates these every single day, and you can just go back and start scrolling if you're in the community, and you can see how these things fluctuate. Now, of course, when GDP is updated, the Buffett indicator changes. We just recently had a GDP number come out. So these are the different things. It's not just one thing that I'm focusing on saying, okay, market's going to crash. I don't know if the market's going to crash. Market might never crash. I do think it probably will pull back at some point pretty heavily, but it's just all of these different little things that just say to me, man, I need to remain vigilant out there. I need to remain patient. For me, I'm looking at saying, okay, I'm getting 5.5% on 90-day treasuries, 3-month treasuries. Why would I not go and put some cash in there for safety? I don't have to risk going and investing in the stock market. I don't have to go risk investing in individual stocks unless I find screaming deals. I'm very happy with 5.5% in a very volatile market, and honestly, just volatile overall financial environment. So the moral of the story here, don't panic. I will see you for tomorrow's video. Later.